Welcome to an Introduction to Economics, brought to you by Parkbench Tutors and narrated by David Hopcroft. For more information about Parkbench Tutors, please visit parkbenchtutors.com. This short podcast is the first on the public sector and is an introduction. We define the public sector as being that part of the economy for which the government has responsibility. This includes central and local government, any public corporations, and other public enterprise. Government influence is most obvious in spending and taxation, but the government also influences the economy through legislation, such as in attempting to control monopolies and in the prevention of the operation of cartels. Public spending is often defined with reference to GNP and GDP. GNP is gross national product, and is defined as the total monetary value of a country's annual output of goods and services. GDP, gross domestic product, is the gross national product less the property income from abroad. What is the point of having a public sector? Why can't we just rely on the market for everything? The main reason for this is that the market mechanism is not geared to looking at all the functions for allocation of resources. The market is more concerned with efficiency than with equity. In most countries, the public sector is growing, and part of that is due to the government's intervening to try and provide equity and efficiency in allocation of resources. The government can intervene in a number of different ways. Preventing abuse of monopoly power and other regulations help to ensure that there is competition for both resources and for finished goods. Intervention tries to provide free entry for markets and aims to provide information and choice for consumers. There are some goods that are not usually provided by the private sector, and the government assumes the responsibility for these services. These include defence and the provision of services such as the Coast Guard service. You should note that some services come under the control of government but have now been privatised and returned to the private sector. These include the supply of gas and electricity, telecommunications, and the rail services. Without government intervention, there would be little incentive for firms to tackle such issues as noise pollution and chemical contamination of waterways. Such intervention is now extending to include disposal of goods that have been consumed, such as legislation on how we dispose of old refrigerators. Without a legal system, there would be no single body to ensure that contracts between suppliers and consumers were adhered to, so the government provides a level of order in the market. Since the aim of government should be to maximise social welfare, the government is concerned with equitable distribution of income and wealth. Lastly, the government is concerned with tackling issues that the market does seem to be vulnerable to. These include high levels of unemployment, inflation, and balance of payments problems. We can now define the objectives of government intervention. Governments aim to maximise social welfare through allocation and distribution functions. Resource allocation means achieving Pareto efficiency, which is what a government budget should aim to achieve. The budget should aim to switch resources between private and public consumption. The focus tends to be more on provision of services than goods, since the government is no longer concerned with production of goods such as gas. The distribution function of the government is to promote equity. This is done by efforts to redistribute wealth, largely through the processing of taxation and the provision of benefits. It is not easy to achieve all objectives, since some may conflict. A particular example is the provision of low-cost housing that may act as a barrier where the private sector needs mobility of labour. Workers may not wish to move from an area where they benefit from low-cost housing to an area where there is a shortage of such housing. There have also been questions about provision of benefits that make it better for some people to live off the benefits rather than seek out a job with minimum wage. One question that all governments have to consider is just how large the public sector should be. Remember that the aim is to maximise social welfare and to determine the optimum size of a fiscal community. There is no market mechanism for determining the size of the public sector or the preference for goods and services provided by the public sector. In theory, the resources are divided between private and public sectors in such a way that the community reaches its highest community indifference curve. At that point, we have reached a Pareto optimum allocation. AB represents the production possibility frontier between the public and private sectors. CIC1 and CIC2 show two community indifference curves. CIC2 represents the highest attainable curve and meets the production possibility frontier at point Z. So point Z is the social welfare maximizing point, and OT must therefore be the most efficient and equitable size of the public sector. The optimum size of the fiscal community is where the social benefit should be equal to the social cost. The benefit from public spending should be equal to its cost through taxation. The social marginal benefit is defined as the extra utility to society gained from each additional monetary unit spent by the government. We assume that this follows the law of diminishing marginal utility. On the map we have inverted the quadrant for the cost of taxation. The optimum scale of activity is now shown at the point where AB equals BC. The size of public spending in the United States is shown here as an example. It should be noted that the general trend has been for a steady increase in public spending. Note that there are two spikes, which are related to expenditure during and after World Wars I and II. Although there are differences in the size of public expenditure, the level in developed countries does not vary significantly. The figures show most countries have expenditure around the 50% mark. The growth in public expenditure for the United Kingdom is shown here. It should be noted that this chart does not take into account inflation, so the figures are not really truly comparable. I've included it to show that the percentage of GNP would be a far more useful estimate for growth. A feature of government spending in recent years is that it has greatly exceeded the rate at which income from taxes has risen. The gap between the two represents debt, which has been financed through borrowing. We shall say more about how debt is financed in a further podcast. There are a number of difficulties in determining which figures to use when we are considering public spending. The obvious difficulty is that there are some items that are difficult to measure in terms of monetary value, such as pollution from noise, the benefit of leisure, and some other services. It is also difficult to compare the needs of nations, since need for benefit in one country may not be the same as in another country. Even more significant, how do we class pensions and social security payments? Do these represent a transfer of resources or a redistribution of income? Since we make payments to national insurance, how do we measure redistribution? It is becoming a practice in economics to try and identify transfer payments and to exclude these from figures for public expenditure. An interesting debate centres on national insurance contributions or social security payments in the United States. A tax is normally assumed to be a payment that is made without direct benefit to the individual taxpayer. However, national insurance and social security payments are conferring an entitlement to benefit. We have seen that public expenditure has steadily increased over the years in the United Kingdom and in other developed countries. However, we have not considered what or how we are financing this expenditure. Let us take a brief look at the financing. This chart shows what we are spending our money on as a country. The main point to note is that social benefits and health are by far the largest components, followed closely by education. Where does the money come from? The chart indicates the major sources of revenue. There are three obvious components: income tax, national insurance and value-added tax. Note that in the United Kingdom the first of these, income tax, depends upon the size of income. The more you earn, the more tax you pay. Note how this differs from a tax on a good. If two consumers each buy the same model of television, then they pay the same amount of tax regardless of any differences in their income. The gap between public expenditure and taxation is the public sector borrowing requirement. This is generally referred to as the PSBR and is stated for each year. Clearly, it depends on the size of the deficit and relates both to central and local government. The amount is also determined by the size of any debt from nationalised industry, any government lending to the private sector or to overseas governments, the receipts from taxation, and any receipts from the sale of assets. This last item was particularly important with the sale of assets such as council houses when that was introduced. The growth in public expenditure is largely related to growth in a few areas. These include the health service, pension provision, and other social benefits. Why has the growth taken place in these areas? One theory is that these are decisions that represent the support of the electorate. This theory seems to be fine when we consider increasing spending during wartime. But since increased spending means increased taxation, then is it really an explanation for what happens in peacetime? The second suggestion is that voters are looking for whatever they can gain as utility provided by the state, and that politicians are seeking to stay in power. So what we end up with is the compromise. In less developed countries, there are other factors to consider when discussing the public sector. Investment in an infrastructure of health, education and transport are high on the agenda for these countries. Without an infrastructure of a civil service, it is not easy to collect some taxes. So there is a reliance on indirect taxes such as import and export duty. These countries also have to cope with deficits, and these are often financed by borrowing from wealthier countries. This ends our first podcast on the public sector, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For more information about Parkbench Tutors, please visit parkbenchtutors.com.